automatically.
Uh,
Welcome back to the Talking Hedge. I'm Josh Kincaid, capital markets analyst and host of your Cannabis Business Podcast. Today we've got Scott Jordan on with us at the Talking Hedge Podcast. He's the founder of the Alternative Finance Network. Scott, thanks for joining us.
Thanks for having me, Josh.
Could you just tell us what you do, how you got into the space?
Sure. I created a company called the Alternative Finance Network after getting started in doing my first marijuana loan in 2009 for a dispensary here in Denver. I live in a suburb of Denver. And I created a network of funding sources because back in the day, there was really very little to no debt-based financing. The way that I created it was through just one by one, helping individual dispensary owners acquire the capital that they needed. What had happened was the short version of a long story is I was working for a leasing company in 2013. I had someone come to me that needed capital to build out their dispensary and their grow, because we were vertically integrated mandatorily back then. And as a result, he referred me to his neighbor, who referred me to another neighbor, and I was able to put together an initial base of customers. Because I was working for a leasing company and we started doing so many deals, we decided to create another company within that company called called Dynamic Alternative Finance. And I was one of the few guys back then in 2014 going to the trade shows and talking about the value of debt-based financing. So I was fortunate in being early. I had my pick of the litter here and managed to provide financing for a number of the larger dispensary chains here in Denver, and have helped a number of dispensary and grow operations throughout the country. Fast forward, Dynamic got sold in 2017. I went to work for a company and decided after about a year and a half of not being able to implement what I wanted to implement there, to create my own company. And so in August of last year, I created the Alternative Finance Network and have continued to expand the number of debt-based financing options that I can provide. I now have over 112 lenders, and we provide access to capital for real estate, working capital, equipment, purchase order finance, accounts receivable, and acquisition financing. And so it's been a very interesting and fun ride here since the beginning.
Mm-hmm. Well, so let's take a step back then and talk about that, because the industry has changed quite a bit. When in 2015, you could have an idea and then pitch that concept and say, oh, I need some money for the license and to implement this idea. Whereas now, people aren't going to go for a letter of credit or memorandum of understanding. They're only going to go after your revenues. So they'll give you, a discount on cash flows, but they're not going to give you money based on just a concept. So how has the lending landscape changed since 2015 from credit card advances and home equity lines of credit to fund businesses to now where you're seeing sale leaseback options? Where is the flow now versus at the very beginning? If you can kind of take us through a quick little journey as to the different types of financing people have been able to get and what they're only able to get now.
Sure. Good question. Certainly larger players have gotten into the market now that it's become more normalized, and there are many more choices for doing larger deals there, because in the early days, people were afraid the feds were going to come in and that they were going to have, an issue. But I think as we've seen, really, there's been no federal intervention on that. Larger companies are becoming much more comfortable. Most everybody in the marketplace is chasing yield these days, as interest rates have compressed. And because of COVID, I think it actually has helped the business because with COVID, we've been determined to be an essential service, and all but Massachusetts and Nevada, those are the only states that shut down their recreational stores. That it's become a lot more accepted. In fact, what I'm seeing now is overseas money is wanting to come into the U.S. here because they're seeing us as a safe haven, and they're not as interested in investing in commercial real estate, particularly office buildings and retail, because COVID has decimated those industries and decimated the cap rates. They're seeing marijuana now as being much safer. So I think it's so funny because we've gone from illegal to essential in a few short years, and so we're seeing many more larger players. We're also seeing some of the banks and credit unions quietly want to stick their toe in the water and see how they can benefit from this expansion and the need for capital. And the nice part about what I do is I've got access to that sort of financing as well, because they see me as being a nice place to clean and screen deals, so that only the best deals come to them, and they don't have to hang a shingle out and say, hey, we're lending, and then get flooded by people that are not qualified in order to borrow. What we're also seeing is that many of the older businesses, particularly here in Denver, which is a mature market, we're seeing businesses with 10 or 11 years of results. So with that kind of track record, you make a large lender, and particularly a conservative lender like a bank, feel much more comfortable in extending credit to you. So capital has become more plentiful and less expensive, and it's a very exciting development, for everyone in the industry, because that's what we all need to expand this thing into really its full potential.
Agreed. And it's going to take that banking to make it sort of essential. And I know that there's a lot of banks and credit unions in Denver that are kind of leading the way. Sunday I think she's an executive at one of them, and definitely an industry leader. So we saw a lot of loans back in the day that have been written off. Aurora has written off $3 billion. A lot of other companies have written off billions at a time. So the old school methodology of going out and getting a convertible note versus other forms of debt financing have kind of shown us that it's normalizing. The industry is starting to attract more sophisticated investors. And I'm wanting to know a little bit about that transition. Are we still seeing multi-state operators coming in and buying up, or are we seeing out-of-state investors? Where's the money flow, and how is it being put? Is it equity? Is it debt? Are we still looking at convertible notes? And who's the one issuing them?
So, because I am not licensed, I don't play in the equity markets like that. What I'm seeing just from an observation point is there's much more money coming into the multi-state operators, particularly the ones that are going into the hot states right now and the limited license states. Michigan, Massachusetts, Missouri. I guess we can start calling them the 3Ms. And they're seeing a lot more investment and a lot of interest there, simply because there's so much pent up demand, and we're seeing very high prices for marijuana, and the wholesale market is really thriving there. We're seeing more people that are also utilizing existing businesses to support just a pure debt payment. And most people would rather maintain all of their equity rather than look at giving up equity in the early stages or having to write a convertible note. And so, for instance, I helped a company called the Green Solution that got bought by Columbia Care. And I remember having a lot of early conversations with them as I helped them grow their customer base and grow their dispensary base here. And I explained to them, look, once you give up equity, you can't get it back. So I know it seems painful to borrow debt that's in the mid to high teens, but trust me, you'll be glad once you went ahead and get a big buyout. And sure enough, last month that transaction closed with Columbia Care, and they were really, really glad that things turned out the way that they had, and they were able to retain their equity. And I think that's the biggest thing for operations that are expanding, is maintain the equity at whatever cost of capital it is, because there will be somebody coming behind you that will be able to offer you much more than you probably think that you're going to get now, and you'll be very glad that you did.
We've been saying on the Talking Hedge podcast for a while that stupid money is going to be coming in with incredible valuations because they don't know where else to put the money. So a lot of these cannabis companies are going to see valuations that are in excess of 10x or whatever their revenues are, simply because the companies that want them, whether it's Coca-Cola or otherwise, they're going to pay stupid valuations just to get in the game. And we can kind of see that from Aurora writing off $3 billion. But, excuse me. Oh, man, I just had a brain fart. I'm glad this isn't live. Hold on. We've had a lot of waste in the market, and yet companies need that cash, and it's incredibly difficult right now to generate revenue. So we're seeing some people give up plant, property, and equipment in the form of a sale leaseback option. Can you explain what that is, and maybe some other forms of debt financing instead of equity?
Sure. What we see the most often is people taking out just straight term loans or equipment leases. It's a lot easier for a lender to get comfortable when he has some sort of collateral as well as some history, with operating. Sale leasebacks are used by companies that have acquired assets, whether it be equipment and or real estate, but it's most prevalent to be real estate. And what it is it's like refinancing a house. You own the asset, you go to a lender, you say, look, here's the asset. I'd like to go ahead and sign a long-term lease with you. That lease is usually for 15 years with 5-year options. And then what the lender does is they impose a cap rate. So cap rates are anywhere from 12 or so to 15%. Just to give you a simple example, on $1 million sale, 12% cap rate is going to yield a investor $120,000 a month. Divided by 12 is $10,000 a month in rent, is kind of the simple way to look at it. And they will then own the building. You'll be able to write off the entire rent payment, as opposed to if you own the building free and clear, you don't have that interest write off, or excuse me, you would only be able to had the same brain fart that you had there.
All right.
Yeah. So with owning a building free and clear and then starting to rent it back, you'd be able to write off the entire payment, as opposed to nothing if you own it free and clear, or if you have a loan on it, just the interest payment. So a lot of times it turns out to be much better way for you, both economically as well as for your accountant at the end of the year, to be able to help you minimize the taxes, which we all know are quite unfair to marijuana business owners here in the U.S. at the time.
So you've been getting calls for quite a long time.
Yes.
For cannabis loans, being in Denver. And so how have those calls changed? People were calling up asking for $5,000 in the beginning, and now they want $5 million. And so how has the dollar amount changed, and the um, I guess the description or what they want to use? So how's the dollar amount changed, and then how is the and Jesus, I can't even talk. How's the dollar amount changed as well as what they want to use with the funds?
Sure. Well, what I'm finding is much more sophisticated borrowers in the industry now. Early stages was a lot of black market people moving into the legal market. Now what I'm finding is much more sophisticated people that have owned other businesses, have done the analysis, have seen other successful marijuana businesses operate, have the metrics and the numbers to know what they've been doing, because so many companies are public where the information is readily available. And what I'm seeing is a lot of equipment needs for people looking to build out a MIP, a grow, some for retail, but we're also seeing, and hopefully closing here fairly soon, on some of the multi-state operators that want to fund their build out and get into larger cultivation facilities, or take existing facilities and retrofit them or build them out. A lot of times in the early days, you'd lease a 50,000 square foot facility, but only be able to afford to build out 15,000, 20,000 feet of it. And so you're paying rent on all of this space that's not being able to be used. And we're finding many people are going back and now looking to build out that additional space because the demand seems to be just, rising like a hockey stick is rising. And particularly with COVID, I think demand has increased. People are consuming more. Some are doing it, for anxiety and to, deal with the uncertainty of the situation. In fact, headlines this morning saw that now President and First Lady have now contracted or COVID and are in quarantine. So you can imagine someone that's as well protected as the president and can get tested whenever he wants. If he has contracted it, and what is the average citizen going to to be faced with here? So there's a lot of uncertainty in the air, and people are consuming, much more, and there's also much more. It's much easier to acquire product because there's been such a nice expansion of not only dispensaries but also delivery services in many areas.
Mm-hmm. You guys have vertical integration in Colorado where a producer can also process and can also sell. Are you seeing more money from companies that want to have total control and have a multi-state operator and a vertical integration, or are you seeing more specific things like they want to be a processor or a producer in a bunch of different states? What are a lot of the calls, if you had to funnel them into producer, processor, retailer, or fully integrated? Where's the majority of loans lie?
I am finding many more people want to specialize in one of the three areas of the business, whether it be cultivation, retail, or processing. And I think what's happening is that there's becoming a higher degree of specialization needed, and many more brands out there. When I first came into the business, there really were, the only brand out there was Dixie, and for a long time, Keef, kind of came up in that era as well. But there was very, very, few other brands. Now there are, hundreds and hundreds of brands seeking shelf space in the dispensaries, and so I'm seeing a lot of that. But I'm also seeing some of the larger guys that want to control the supply chain all the way through. And as a result, they're building the cultivation, they're then, wanting to build out the MIP and then also have control over the retail stores as well, because you're still going to need, shelf space, and because the margins are so much better, in retail, generally you're getting about double to triple the price that you are in terms of selling wholesale. And so each state is a little bit different in terms of, what they're going to allow. And I think it makes for a very exciting marketplace, having, the diversity and the intensity of the entrepreneurs that are coming into the marketplace, because it's now, what I see mostly is money guys that are now hiring or bringing on for a small piece of equity the early stage black market growers and retailers. And what they're doing is they're hiring the expertise, because what they're doing is they're seeing the margins in this business are very, very good. And again, because of the pandemic, this has been deemed an essential service. More and more people are getting comfortable with it. We're also seeing more and more of the medical benefits that people are experiencing, and more and more research that's being done in terms of that. And I think that really bodes well for a great 2021 and beyond in this decade for the expansion of cannabis and cannabis sales.
So before we wrap this up, I got to keep it short today, but I want to have you back on. What does your crystal ball prediction say for 2021, just based on the 6-7 years experience you've had, and then with this whole pandemic kind of blowing things up? Where are things leading to, and where do you think they're going to go?
Wow. Well, I would have never predicted the back-to-back craziness of this, of what has taken place in 2020. I mean, the only thing that I think has not happened is the locusts haven't arrived here. But I would say, I think obviously we're going to see continued expansion of and the adoptance of marijuana. I think certainly states that are not that don't have a marijuana program, I think are going to accept it and adopt it. And I think the adoption is going to be similar to how things have been with gay marriage, where now it's not the oh my gosh, what's going on here? But we're seeing it as a more, normalized way. Many of the states that are, starting to build out are going to, be more mature and be able to serve their markets. They're still restricting sales in certain states on the retail area because they don't have enough product and they don't want to disappoint their customers. So, can you imagine going into a grocery store and saying, no, you can only buy, one package of meat versus two? Well, I guess we had that in April and May, for a little while, but, it really was abnormal. I think we'll see a continued consolidation as the big guys get more access to capital to be able to acquire, the weaker ones. Here in Denver, because we're a more mature market, we're seeing a much more consolidation of businesses, and the smaller mom and pop businesses are getting bought and rolled up into the larger ones. And I think we'll start to see more big weed, and I think it'll be marijuana 3.0, where we're going to go to, just like any other market, the small guys start it, they get bought out, the big guys, take over, and we'll see more and more multi-state operators be able to expand their footprints and expand their expertise. And I think we'll see delivery in a lot of states. And then I think a lot of states will, I think we'll see 3 or 4 new states that will adopt adult use because of the taxation and the jobs. Let's face it, we need jobs after the decimation that we've had here with COVID. We've got to have jobs created. And this is one of the industries that is creating jobs and good paying jobs for the most part, as well as a lot of ancillary businesses that can benefit from needing the services of an accountant, needing commercial loans, needing other services that are essential to any business, but are going to be absolutely needed by marijuana companies that want to play within the rules and be able to have good accounting, good reporting, and be able to grow their businesses efficiently, just like any other manufacturing and retail businesses.
Yeah, a lot of these states and even the federal government is going to need cannabis to shore up their budget deficits. So I think definitely is going to be an interesting time. Maybe they'll fast track not only delivery, but federal legalization as well. We just got to come back to the Talking Hedge and find out.
I agree.
I want to my guest, Scott Jordan. He is the founder of Alternative Finance Network. Scott, where can they reach you at, either social media or personally?
They can reach me at sjordan at alternativefinancenetwork.com. On LinkedIn, I'm Scott Jordan, the marijuana money man from Denver. And that's really the social media and what I use. You can go to my website, which is www.alternativefinancenetwork.com. And I'd love to help you with your financing needs and to help you expand the business, maintain your equity, and maintain the control. That's really the key thing. Maintain the control early on while you can.
Perfect. And we'll have all those links in the show notes as well. All right. I want to thank my guest, Scott Jordan. With that, we're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge. Don't forget to like, share, and subscribe, or don't, and I'm out. Cool. I'll probably have this up, Scott, in a couple of days.
Sure. Great.
Next week, probably.
Okay, so you stop recording because I still see the red button at the top.
I can't stop recording, otherwise it's going to end the whole thing.
Okay.
So I'll just cut that out post-production.
Okay, great. Thank you very much. And will you send me a link then when it's up?
Yep, when it's up, I will send you the link. I'll let you know, and I will tag you in to as much social media as they let me.
Great. Good luck with your battle with the Seattle City Hall.
I appreciate it. And then let's try to get back together after the new year and see just a little follow-up.
Sure. Okay. Will do. Thank you, Josh. Take care, buddy. Bye-bye.